What's up, everybody? It's Mozzie the Trader. I'm back with another video. I do hope all is well, firstly. Secondly, I have a special video for you guys today. As you can see, we are going over a beginner's guide to understand Wyckoff trading logic and concepts. So I'm quickly going to go over a few things on a PowerPoint, and then we're going to get into some examples on the charts. So I do want to give a disclaimer that nothing discussed in this video is deemed financial advice, and I am not the creator of these concepts. I'm rather explaining them from my own experience and perspective. So with that being said, let's get right into it. So first things first, before we even start, I do want you guys to, if you have any distractions, cell phones or anything like that, put them down. You want to be undistracted. You will need to be fully attentive on this video to dissect the information fully, right? Okay. So first things first, this is an important video because I know a lot of people see Wyckoff schematics and they get intimidated, right? Or they may seem to think it's just another strategy, or they may not know about it at all. And in that case, I mean, there's even people that are trying to genuinely understand Wyckoff, but they just need a little help, which is understandable. And that's also my goal here today, to basically make the complicated comprehensible for you guys and, you know, turn everybody into Wyckoff traders. No, but I do want to definitely make this easily understandable. Hence why I said beginner's guide to understanding Wyckoff logic concepts. So this is definitely how you should approach learning Wyckoff. Briefly, who Wyckoff is: stock investor born in 1800s. He's a Wall Street trader. He was the founder of the magazine of Wall Street, and he coined the terms such as support, resistance, and the composite operator or the composite man. Today, we refer to that composite operator or whatever as the market maker, institution, banks, etc. And he actually derived his methods from the study of reoccurring market behaviors back then that would signal when the market maker or that composite man was planning the end of the markets, and he would enter along with them. So that is exactly what Wyckoff is, just breaking down when the large operators or the market makers are ready to enter a market, and we're just moving with them, right? Point blank. So for one, this is not a strategy. I repeat, this is not a strategy. This is not the typical head and shoulders, trend line, break and retest, technical analysis stuff. Nothing is wrong with that, but Wyckoff is totally different, right? So only logic is applied, and the logic is extrapolated from factual data from the market. The information from Wyckoff is over 100 plus years old. Again, he was born in 1870s. That was before charts were even digital. And they were using point and figure diagrams that they would draw themselves to illustrate price, right? Imagine having to literally draw Forex. Imagine having to draw your charts every day to know when to buy or sell. So you can only imagine how good he had to be able to do that without the technology that we have today. Because I'm pretty sure you wouldn't be able to imagine trading blind or whatever the case may be, right? So genuinely, Wyckoff, there's buy models, there's sell models. So all right, so generally Wyckoff, there's accumulation, distribution, reaccumulation, redistribution. Simply put, accumulation is the buy model, distribution is the sell model, reaccumulation happens after accumulation, redistribution happens after distribution, right? So each of these models have more than one schematic. So accumulation has two different schematics. No accumulation is the same exact as the last one. Same thing goes for distribution. Each of these have at least two main types, and those two types usually have a distinct difference, but it's not anything too hard that you won't understand it. Like, you'll definitely be able to spot the differences in the types of schematics there are. So first thing I do want to tackle is the common misconception with schematics and labeling. This is something that I had myself, a problem that I had myself. What I mean by that is that when I first started trying to learn Wyckoff, I would go look at these schematics, look at these diagrams, and I would try to go straight to the charts and just label them up. I would try to point out any high, any low, and just put each of those initials in those respective spots and think that I was, conquering the world. I thought that I was doing a damn thing. But little did I know, I was hindering myself because I wasn't actually comprehending what was going on within the schematic. I was just trying to make it look like what Wyckoff was doing without actually learning what's going on, right? So to start off, to even understand Wyckoff logic, you have to understand the 3 laws of Wyckoff. Those laws are supply versus demand, cause and effect, effort versus result. And I'm going to go over these briefly. I want to make it simple. So if you do need to pause this part and take notes, feel free to do that. If you need to rewind this part, do whatever you need to do to make sure that you understand. Watch this video as many times as you need to. So supply versus demand, simply put, determines direction of price. When supply is greater than demand, prices fall. When demand is greater than supply, prices rise. Demand is buyers, supply is sellers. Sell strength versus buy strength. That's all it is. That determines direction of price, right? The next law is the law of cause and effect. So simply put, for there to be an effect or a breakout, in this case, there must be a cause first that originates it. What is the cause of the breakout? The consolidation. So consolidation or the range, something to note is that every range has a breakout. So every consolidation breaks out. Every breakout has a target. And those targets are the larger operators' desired price points. Those are the prices that they want to drive to, right? So essentially, we're looking at each Wyckoff schematic or each Wyckoff range is essentially another consolidation, right? So we're anticipating the breakout and we want to get in right before the breakout and ride to those desired price points with the larger operators. And I'm going to show you exactly how we can do that. So the third law is effort versus result. Simply put, effort is just another word for volume, right? So you have buy effort and you have sell effort, right? So volume is the larger operators' footprints and it highlights their activity. So high volume or high effort should result in high price movement. High price movement is with the long bodies, short wick candlesticks. So those are strong candlesticks, not dojis or anything like that, just engulfings and things of that nature, right? Things we see when we're breaking structures. So again, high volume or high effort should result in high price movement with long body, short wick candlesticks. So inconsistencies between effort and result usually means a fake out. In other words, manipulation. Moving on, one thing important that I want to note is that volume is recorded candle for candle and is respected to the selected time frame. So meaning daily, weekly, monthly, one volume bar on that time frame represents one candlestick. And you'll be able to see that, you'll be able to follow it with your crosshairs, and the more you're able to understand this, the more you're able to see those fake outs and stuff like that. Another thing to note is not one retail trader will ever have an impact on a volume bar. Not ever. Volume bars are strictly the larger operator footprints. That is the most important thing that you can understand. Again, volume shows us the larger operators' footprints. It shows us their activity, right? So moving on, phase analysis. This is what I feel like people should focus more on. Phase analysis rather than trying to label each and every turning point of the market. Just trying to label it verbatim and have it look like a mirror image, right? So what we want to do is analyze the phases, phase A, phase B, phase C, phase D. Want to analyze the phase behavior so we'll be able to understand when we want to get in the market and when we don't, right? Because if we don't understand that this is phase B and we enter a buy right here thinking that this is some sort of support level, then we're only going to get stopped out, right? So we definitely want to be able to understand these phases, dissect them so we can come to a conclusion on when it is that we need to enter and ride the coattails of those larger operators, right? So starting off phase A, we stop the trend. How do we stop the trend? Usually there's a climax, seller's climax or buyer's climax right here. So we have a new low. There's an automatic reaction. This automatic reaction is the high that we create from that low. Then we have a secondary test, which is the confirming of phase A. It is the confirming of us stopping the downtrend, because if we didn't have this secondary test in phase A, then after this automatic reaction, we would just continue structure to the downside, break that previous low, create lower lows and lower highs, right? But we don't. We refuse to go lower, and now we go from trending down to trending sideways. So phase A, we have stopped the trend, right? So just read this out. These events, this sequence that stop the trend from continuing and creates the support and resistance for the incoming trading range. Volume price analysis is most prevalent near those areas, the support and resistance, as the range is observed, right? So again, the third law of effort versus result is most prevalent near support and resistance, right? Because high volume, we should be breaking these levels. So if we get any sort of manipulation near these levels, then we know that they're fake outs, plainly put. So after we establish that the trend has been stopped, again, seller's climax, automatic reaction, secondary test. Unwillingness to go lower, we stop the down move, and now we're moving sideways. Phase A is complete. Phase B is what builds our cause. And again, the cause is what comes before the effect. The cause is what creates the intensity of the effect. So the cause, or the longer the consolidation, the longer or the higher the breakout would be, right? So in phase B, what are we doing? We are testing the levels that we just created. We're testing the support and resistance that we just created. Our selling climax and our automatic reaction are going to be the support and resistance for that trading range, right? So in phase B, we're just testing that range and we're absorbing the price action on one side, meaning absorbing, we're making one side of the market weaker than the other. So we're absorbing supply or demand in phase B, right? Okay. So in phase B, you tend to see more secondary tests, failed rallies, which just mean a failed up move, up thrust actions, or signs of weakness, which are all tests to the support and resistance, but they result in us coming right back into the trading range. So our resistance and our support are right here. Phase B starts, we come outside, come right back into the trading range. Again, pop outside, support, right back into the trading range. Test resistance, back into the trading range, and again, so on and so forth. All right, same thing here. Resistance, phase B starts, we break out, we come right back in. Support, we break out, come right back in, right? So we're just testing each side of the market, and one side is getting weaker than the other, right? So again, shortly, during this phase, price consolidates and tests the support and resistance of the trading range. We'll often see false breakouts that quickly return into the trading range, and it will sometimes have inconsistent volume signatures. Again, remember, high effort should have a high result. Anything other than that is a false move. I don't know what that was. Right. So if we have high effort with a low result, that's a false move. Right. Low effort, high result, false move. So on and so forth. All right. So moving on. Don't really get too caught up on seeing these because the next page will be sell models as well as the other two phases. But the characteristics remain the same, right? So phase C and phase D. I'll briefly go over again what happened in phase A. It's just the sell side is just flipped. So you see phase A, B, C, D. So phase A, you see we have our climax, automatic reaction, secondary test. Secondary test confirms that we have gone from up to moving sideways, and that's the end of phase A. Phase B, we are testing those levels of resistance and support made from the climax automatic reaction, right? Poke outside, back into the range. Poke outside, back into the range. Same thing here. Climax, automatic reaction, that's our resistance and our support. Secondary test confirms that we are moving sideways and not up anymore. So phase A has done its job in stopping the previous uptrend, right? So phase B, again, pop outside support, pop outside resistance, and we right back into the trading range. So phase B, we're building a cause and we are absorbing one side of the market. We are either absorbing supply or we are absorbing demand. And what does absorption mean is that basically it gets weaker and weaker and weaker until it's non-existent and the other side of the market moves very easily and it's way stronger. Again, remember, first law of Wyckoff is supply versus demand. Supply is greater than demand, price drop. Demand is greater than supply, prices rise. It's that simple, right? Okay, so starting with phase C is the final test of the range, right? So you see here, we have phase C and we have phase C down here, right? So the main difference between the two schematics is on the buy side and sell side. The buy side, since it's sell side, I start there, but you will either get a UTAD. This breaks the high of the climax, or you won't get a UTAD. We did break the high of the climax, but that was in phase B because we came right back into the trading range. Phase C, we broke the high and we actually moved down. And once we tested the low, we kept going down after phase D, of course. But essentially, phase C is the final test of the range before we switch direction, right? So up until this point, we've been moving up. And this is as high as we'll go before we start to move down. Same thing here. We've been moving up for the most part. And now this is the highest we'll go before we started to move down, right? Okay, so phase C is our testing phase. You usually get a spring, UTAD, or just a test. And this phase is usually not should add an LPS to that because it's not always a spring. But this phase is usually the shortest. It's the final shakeout of the trading range. Also be the lowest or the highest point for the new trend to be established, and price will trade through the trading range rather quickly after phase C, and volume should confirm that movement. Also, phase C, you will often get the first chance to enter the market during that phase. And again, how we establish where our targets are going to be, how they did back in the day, they were using point and figure charts. We have technology at our hands. We don't have to do that anymore. So what we can do is use the fib extension tool to measure the move and come up with some targets that make sense based off of the cause that was built. Based off the consolidation, we can measure the consolidation. And again, the law of cause and effect is applied here. So we're measuring the cause to determine the effect, right? And remember, those targets are the desired price points of the larger market operators. composite man, institution, banks, whatever floats your boat, right? So again, that's phase C, final test of the range. Then we have phase D, which is the markup or the markdown of the trading range. Here you'll see signs of strength, backing up action into LPSs, last point supply, things of that nature. Excuse me. So phase D actually shows strength by easily trading throughout the levels of the trading range. We're going to start breaking structure violently, and we'll have shallow retracements, and those retracements will provide re-entry opportunities if you didn't get in phase C, right? And so upon those re-entries, we are going to take those to those breakout targets. And again, volume should reflect the direction at this stage. There should be harmony in the volume. You should not be seeing inconsistencies at this point. We should only be seeing ease of movement. See, now we start to break out of the support and we're trending to the downside. So that's what volume should reflect that, right? So I do have something special. This is sort of more advanced. I actually did coin this phrase, so I'm gonna take ownership of it because I have never heard anybody use this phrase before, but it fits the situation, right? So climactic exhaustion, that's my confirming entry. And you'll mostly find it at points like this, LPSY, or you could even also find it at the test, right? So essentially what it is after we cause this drop, that pullback, since we are at a high, we're at an important point in price, that pullback, if it has high volume, then we should be breaking the previous high that we just set, right? So if that pullback has high volume, but we create a lower high, which is a low result, flip side with the buy side, if that pullback creates a lot of sell volume, but the result is a higher low, then that confirms the absorption of buyers or sellers. So on this example, excuse me, my throat is so dry. So on this example, the pullback, boom, it will result in a lower high, right? Again, pullback will result in a lower high. So on those pullbacks, if volume is very, very high, but we're getting basically not getting the result that we would want from that high effort, and that confirms that the other side of the market is indeed absorbed. They've been weakened and they don't have enough strength to fight back against the opposing forces, right? So this is telling us a story that either supply or demand has taken over and is now strong in the market. And again, remember, the first law is supply versus demand. So whichever one of these are stronger are going to drive prices in that direction, right? Look for buys if demand is stronger, sales if supply is stronger. Simply put, that's an ugly arrow. There we go. All right. So does that make sense? I'm asking like I can really see somebody saying yes or no. Anyway, again, this is where I would look for that quote unquote climactic exhaustion, which is basically just meaning a pullback with high volume, but lower result. Okay. So now we have just went over all 4 phases, what we expect in each phase. So next I want to get into some examples, but before I do that, just give you guys a quick review. So again, phase A, we're stopping the trend. Phase B, we're building a cause. Phase C is the final test of the range. Final test outside those range levels, support. See, this is farthest we'll go. Test. And then this is the lowest point that we go before we reverse. Again, the second type of schematic for the buy side is one without a spring, where we create lows in phase B, and once phase C comes, we just create higher lows from that point. So there's either going to be a violent shakeout or a slower move to the upside that doesn't induce people to sell, or it doesn't have a violent manipulation, or whatever the case may be. We're just creating higher lows, and from this point, that'll be the lowest point of the new trend, right? Okay, and then again, phase D, we are showing strength. We get minor pullbacks to give us more entry opportunities to get to that targeted price, whichever that price may be. Okay, so those are our examples, right? So before we do get into the chart examples, our main goal is to basically identify the bigger interest, desired destination, or price point, and we want to ride with them to it, right? So we're either riding along or you're getting ran over, because as retail traders, we will never have the same impact or influence on the market that the market makers do. So moving in harmony with them will only guarantee our success in the market, right? So just another thing to note, in general, Wyckoff ranges are consolidations. All consolidations have breakouts, all breakouts have targets, and all targets are desired price points for larger operators. So we want to desire those price points as well. All right, without further ado, I'll get into a couple of chart examples and I'll let you guys go. All right, so my first example will be a sell model for GJ. All right, and I'm just going to get straight into it. So we do see this up movement, right, come to a halt from this high. That's not what happened. From this high right here to this low. This would be our buying climax, automatic reaction, and our secondary test. Our secondary test is the rally that tries to test the climax, and after we fail, that guarantees that we are not moving up anymore, but we are moving sideways now, because this easily could have broke to the upside and continued the buy structure, right? So now we have established that phase A is completed. After this failure or our secondary test, and now we have also a minor level of structure here. Right? Okay, so this is phase A because we have successfully stopped our trend. So if you want, we can label this as buyer's climax, automatic reaction, automatic rally, and secondary test. Right? Phase A is complete. Now we get into phase B. And remember, phase B is going to test these levels of support and resistance that we established, right? So phase B starts. Let's put my B up here. So phase B starts, and immediately we get a break to the downside with what you would see as growing sell volume. Sell volume is higher at this point, but we failed to break and maintain momentum outside of the trading range, which tells us what? That this sell volume is not conducive with the result. So this effort is not leading to the result that it should. It's high effort, low result. Go right back into the trading range, right? So we come back up, and again in phase B, we test the previous high that we made, the secondary test, right? So we're looking at volume as we're pushing up from the buy side, and you can just see that it's locally increasing, right? So this should denote strength, right? Since this is the larger operator's footprints. But Just because you have high effort doesn't mean that you have a high result. And that's where we see our inconsistencies at, right? So on the way up, volume is increasing. Once we get near this previous high, volume is starting to drop off, become non-existent, right? So again, we have a test to that high, we pull back, and we just can't break this previous level of structure. Now we have phase C. On this push up, what do we see right here? Higher by volume than anything in this whole range, right? But it doesn't even break our initial climax high. So just for kicks, let's mark this up. So this pop outside would be a sign of weakness, and this upthrust would be simply that, upthrust move. And this is your upthrust. Upthrust happens in phase C. All right. And so after we try to break this previous level structure, we go right back into the trading range, and we end up breaking these minor levels of structure, indicating that the market is most likely ready to turn around based off the fact that we had a lot of sell volume come into play. And on top of the fact that buyers have repeatedly shown that they do not possess enough strength to break out or even get to this previous level, right? Right. So phase C, we get this reversal pattern. We come down, make a low, and again, we start to retrace up to that previous level of structure. And what happens when we get there? We get a reversal. So this is our first lower high, that point, and look, from that rally after we drop from this point to this point, we're seeing that volume was lower, getting higher, getting higher, getting higher. But once we got to that point, volume was high and we created a lower high. So this is what I mean by that climactic exhaustion, because volume has increased on the buy side, but it led us to a lower high, right? Not only did we get a lower high, we got a reversal candle. So this is again what I mean by in phase C, reversal formation. I'm sorry. Phase C will usually give you your first entries, which are typically more aggressive, but if you can spot this and you can spot the early signs of weakness on the other side of the market, then this entry is totally fine by any means. It's definitely the best entry, preferred entry as far as risk reward goes. And from that point, you'll receive, a larger payout if you're holding to the max potential. All right. So now we have our area interest to entry on phase C. Next comes phase D. So first we want to get out of the way, what target points are we using? So again, remember, we're not using the point and figure chart, we're using the trend extension tool. We're going to go from the up thrust to this first lower high, which would be a LPSY. And now we're going to mark off where our targets are based off of that range. So we have the 1618, first target, 2618, second target, 3618, third target, and lastly 4236, right? So this tool basically gives us a measurement of how far the breakout should go based off how long we were in this range, right? And essentially we were in this range since about January 13th to January 6th. So about 5 or 6 days we're in this range. So you could see another 5 or 6 days of dropping or price failing to go higher and so on and so forth, right? So now we're in phase D. And what do we have again? Right after that, we have another pullback, high buy volume, results in a lower high, this close is a acceptable spot to open the trade again. So trade up here to the first target, that's 130 pips, whatever the case may be. Even the second trade to the first target is 82 pips, right? So what we want to do is make sure that this trade is going to truly break out. Like I said, phase D, we do pull back. Phase D, we do break out and give shallow pullbacks. Now, this pullback is a bit deeper. We are back into the trading range, but what I do want to highlight is that if we go from the high to the low of the original range and highlight the 50%, right? The 50% of the range sits right here. And we can see that after phase D pops out initially and we come back, one large volume signature, larger than anything else, again, should definitely give us a higher result. But again, we don't even get to equilibrium. In fact, we fail and we come back, we try to test and create another reversal candle. And that's another entry that you can take to the additional target. So essentially we have, let me clean some of this up, right? So we have a entry from phase C. After buyer weakness is confirmed. So first target, second entry, and my second entry is on the close of this reversal, right? And in retrospect, you want to have your stop loss above that sign of strength bar that's engulfing both of these candles. But it just depending on how you choose to enter trades is what you would determine your risk off of that. But overall, just concept wise, that's the safest stop. Kind of unattractive for me myself. 39 pips is way too much. So if I could get in there and refine that, I definitely would. But now we are going to our second and third targets. And every pullback from that point gives us a new opportunity. Trade to the lower targets. I'm sorry about that. So now we have two trades with 300 plus pip potential, because what have we done? We dissected the range and we realized when the market operators are entering the market and when it's true. And we have also disproved one side of the market. So we've used the law of supply versus demand. So we're definitely equal at this point, but we start to show that demand is getting absorbed out of the market and they're becoming weaker and weaker. So the buyers are not able to fight against the drop in price. So supply versus demand, supply is winning. We have the law of cause and effect. We spent so much in time in this range. Now our price points are based off the measured move, off that consolidation. So now we have the consolidation. Consolidation has a breakout. The breakout has targets, right? So we've used our three laws. Again, use law effort versus result on our entries to confirm our entries and also to confirm or disprove when price is not in harmony with volume. So all three laws in play, all targets are hit in respect to that trend. So that sell model is complete. So I hope that makes sense. Again, you guys, if you have to rewind this video, watch it as many times as you can. That's definitely cool. Second and the last example that I do have for you guys, because I don't want this video to be too long. I mean, I'm pretty sure it'll be a little lengthy, but for the most part, I feel like it's going to be worth it. Most definitely. So the second schematic that I have for you guys is a buy model on AU, right? We're dealing with a type 2 accumulation. I'll explain that later. But we have climax, automatic reaction, and secondary test. Secondary test neglects us from going lower and looks what happens. Look what happens. High volume signature, high effort, low result, because that high volume signature should have definitely broke that low and had us continue in that cell structure. So that is phase A. So we have went from trending down to now trending sideways. Phase A. Phase B. Again, we are testing the extremities or the support and resistance of the range. So we come up, test the high, back to the trading range, and test the low. Extreme test of the low again, and we go right back into that trading range, right? So again, look at this volume signature for this bar. This is very high effort, very low result. Because look at the candle. This is a long wick, short body that doesn't resonate with the type of effort that came into the market. So we know that this is a fake out, right? We go right back to the trading range. We actually break the high, and at that point, volume is so low, it's virtually non-existent. So nothing past this high is sustainable. We come back into the trading range, right? But what now I want to pay attention to is we did create other levels of structure right here. I'm going to change the color. Here and right here. In phase B. So after we make that move up, again, volume is virtually non-existent on that move up, so we do not sustain any momentum past that high and come back into the trading range, right? So what happens on this decline, right? What do we see? Hope the arrow gets out the way, but you see the sell volume is increasing on the way down. What do you want to see when sell volume is increasing gradually? Some sort of breaks of structure, or at least a further test to the downside. But what do we get? A higher low. And remember, you have those buy models that don't always break the extremities of the range. It doesn't always give you a huge fake out, but you will get a higher low from that point. So now we are in phase C, because this is low as we will go before we reverse, right? I'll keep doing it. So phase C, let's see here. 1 second. Ouch. Yeah. So again, phase C, this is the lowest point we'll go before we actually reverse. So phase C comes in. We have our higher low that is formed and is actually held, as you can see here, even after we come down here and we get what? Another high volume, high effort from the sellers, but what happens again? Another higher low. So again, that's another example of what I call the climactic exhaustion, because we have a high effort, but it's high effort from the sellers, but it results in a higher low. Doesn't make sense. This effort is higher than previous, and we don't even break that low with more effort. So what is that showing you? Or what does that tell you? We have more effort from the sellers, but we create a higher low than we did last time with less effort. Telling you that, okay, supply has been absorbed, right? And the sellers are not strong enough to fight against prices going higher anymore. So this is the end of phase C, because we actually start to trade out of the range and break those levels of structure and keep trading to the upside, right? So now we have phase D. And again, I do know that I said that phase C usually gives you your first opportunity to enter the trade. And what happens is we do get that higher low on higher sell volume. And now we have the reversal candle, right? So we're looking at entries right here. And we do want to use our fib extension tool to see or to measure this move. So we will go from the low of phase C, I think it's right here, high in the first LPS. And now we have our targets, 1, target 2, target 3, so on and so forth, right? So those targets are the effects of this consolidation, right? Okay, so first trade, we are opening at the close of this sign of strength, this engulfing candle, and then what do you see there? The high volume, high effort footprint of the market makers, composite man, whatever you want to call it, right? Because look, we're getting high volume and a long body, low wick candle. So that is confirming that the buyers are in the market. Demand is definitely higher than supply. The effect from the breakout is definitely this whole range here. And again, we definitely use all 3 laws when dissecting this range because now we know when to enter. And we have our first target here. So first trade is 3-to-1, 50 pip TP. Second TP is 96 pips. Third TP is here. Unfortunately, we did not get there, but after the second TP, there's other things we can do like trail stop loss, things of that nature, right? And second entry, phase D, which would be the more conservative entry, is after we break out, we have this shallow pullback. Again, there's a small local increase on the sell side, and then we create, again, that reversal pattern. So our entry at the close, the candle, and we are aiming for the next target. So again, you have 2 trades, a very good risk to reward ratio. Overall 96 plus 64, looking at overall 150 pips. And you do see that you're on the right side of the market because once we push up and break structure, we're getting high volume signatures on the buy side. And we're getting our follow through. So that's how we know that we're riding their coattails. We're not getting ran over, but we're catching our rides to those desired price points that they want. And we didn't reach our third take profit level, which is okay. Based off this range, we weren't in it very long, but we were in it long enough to get something from the breakout, right? Okay, clean that up some. All right, man. So those are just a couple examples that I have for you guys. I will be back with some other videos pertaining to Wyckoff. I'm going to be going over volume more in depth. Also going to be answering any questions that you guys have for me. So again, that's it for today. If you guys learned anything from this video, just do me a quick favor and throw me a like, subscribe, and share the video to anyone you think can benefit from this information. All right. Thank you guys, and I will see you next time. I am out.